wondered why Let's get ready to rumble. Woo! How's everyone doing? Ooh, welcome to the stream. Let's turn some of this beep bop music. Boop bop beep 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 beep. Down. Let's take a look at the markets. Hop in here. Oh, yes. A lot of chop. A lot of chop in the markets. What's going on, everybody there at Twitch? Is that cannabis? I don't know. I don't know what you're referencing. What's up, AA? Oh, it's Moonraker. Of course it's Moonraker. I should have known. I should have known. Somebody's trading some SoFi, NNE. We got some people talking about AMD, NNE. Nice. Hopefully everyone's doing pretty good today. Market's chopping around. We got earnings after the bell, right? Google. No surprise. If you weren't able to catch my market brief last night, I posted it out on X. Just a quick kind of like a recap of the markets overall, but we're going to take a look at some of these 15-minute time frames, the shorter time frames, because it really doesn't look all too bad right now. I know that Google is going to come out and all the other earnings, right? So we have, what else are the earnings we got? So Google, we'll talk about AMD, we can do that. But then we have Microsoft, we have Amazon. These are all after the close. So what's going to happen here, this is my assumption, is what's going to be taking place in the markets, is things are going to be setting up, they're going to look good. You may be bullish and you may want to wait. We have this wide open expected move, but my guess is that the market's going to get the report, whatever that may be, however the market interprets it, and we're just going to see these gap ups. So it's going to be one of those things where, hey, the market looks like it's setting up. It looks good. Should I go long? And then if it goes against you, that sucks. But then also, if you don't get in, you can potentially miss a pretty decent move. So how do you approach these type of things? And the way that I approach these type of things is very simple. One, I don't get really directional based risk on the individual equity themselves unless I'm very focused in on that position sizing, right? So if I was to trade Google, which I'm not, and I'm bullish Google, I would really want to know, or bearish, right? I would really want to know what its expected move was for the trading session going into earnings. And right now we're looking at roughly about an $11 expected move. Now, Google was one that's been on my radar for a minute now, and it's been looking fairly nice, right? We pulled into an inclining 200-day moving average. We've held it multiple times. We saw some strength, and now we're moving into a binary event that could literally take us from here and bring us easily back up here and to potentially even fill this gap from over here. That's just the reality of earnings. Now, on the flip side to that, you might be saying, ooh, I want a piece of that. The flip side of that is it's a binary event, so we can also be right back down here, which in my opinion still wouldn't be all that bad. We get an undercut, maybe perhaps we'd see some strength right back into this little period of consolidation. So, oh man, fun times, these earnings. So far, we've been seeing some decent moves off earnings on some names and not so decent on others. This is ES. This is the book map. I'm just looking to see if there's any levels of liquidity here worth noting for the trading session, and there's really not. There's not much going on. We could scroll out further. Some levels down there at around 5,800. Not much going on in the book map. I'm going to go ahead and close this because sometimes it slows down my stuff. We'll pull it up later if we need it. Okay. Now, the expected move for the week is over $10 for the SPY, which is over $100 for the SPX. And we're still above the 5-day moving average, but it's declining here at this moment. And as you can see, we started with the gap down, a little sell side activity. It recovered after we got through JOLTS numbers and everything. And it honestly doesn't look all too bad right here, right? It looks like we can pop off and start heading higher. So we got to take a look at market net flow. What's market net flow telling us? Market net flow, It's not giving us much. It's a bullish divergence right here between the cumulative net premiums of calls and puts. They're kind of both going up hand in hand. And then you could see the convergence, meaning is SPY, the white line, moving with market net flow. And right now it's not. So it's not giving us really an edge. Some of the zero date levels this morning was 58.45. We came into that. We found resistance. We came back up, and we're coming right back into that level. The key level that we were paying attention to on last night's quick market brief was 58.50. My thing was below 58.50, I'm not necessarily bearish, but I don't really want to trade too much into the chop. I'm not really that interested in like adding more exposure to my specific portfolio. And we came down here to and around the gamma flip line. Actually, I believe that the gamma flip line actually updated. Or let me actually make sure here. Yeah, so it updated. It was 58.15 in the morning. Now it looks like they ran a little bit of an update there to 58.05. So we did touch into negative gamma territory for a moment earlier in the trading session. And when you're in negative gamma territory, you can see volatility typically increase. And volatility is remaining rather elevated. And we could see, selling into selling, buying into buying. You get some crazy whipsaw type moves. We've been kind of seeing that here when we hit into negative gamma territory on the 23rd. You get a sell side, boom, you snap back, sell side, boom, snap back, boom. A lot of so in my opinion, I'm looking for more to hold above 58.50. 58.50 just seems like this pin that we've been stuck at. And if we can get unpinned, maybe that opens the door to start actually seeing the market go through its most bullish period of seasonality, which we're basically in right now. But the market's also at all-time highs. Now, if I pull up the Qs, this is kind of cool. So the Qs, to me, don't look, once again, we're reporting again, right? We're reporting earnings. But overall, the chart, it really does not look bearish at all. We're above a rising 20, a rising 50, rising 200. It's literally just been consolidating, kind of shaking some people out here. And we're not too far from the all-time highs. It seems like the market wants to go test the all-time highs. The 5-day moving average, to follow up on last night's quick brief, it was green. It was one of the few that were green. This and I think semiconductors, to potentially turn in a little yellow. And we said if it can hold this, that could be a bullish sign. And you could see we broke this downsloping trend line. We kind of broke above it. Perhaps we come to back test at some point. But right now we're on a little bit of a breakout while we have a rising 5-day moving average. So Qs look fine right now. Can that change in a moment's notice? Absolutely can change in a moment's notice given the context of what we're about to be walking into. Semiconductors are up slightly on the day too, and semiconductors also don't look in that all too bad here. So to get all bared up, it just doesn't make sense. It just doesn't make sense to be all bared up. Can we just have a random, market event? Sure. Good luck timing that every single time, right? Because typically strong stocks get stronger, weak stocks get weaker. One of the things that we've been talking about that we've been noticing is the SPY, which is more of a broad market. It's been at all-time highs, and we're just floating around these all-time highs here. I don't know what this is. Let me remove that. Okay, and we're just really consolidating right here. And the interesting aspect here of that is that Qs is typically the leader, and Qs, you can see that we have not hit a new all-time high since July. And sometimes when you have Qs not leading the way, that's not a good sign. So there's one of two things that really happen here. The S&P 500 is going to come off, and the Qs are going to be the one that could be giving us that insight. And or the Qs have a catch-up play to take place. And if the catch-up is going to take place, it could do so very well on these earnings that are about to come out. And we could see the Qs rip. So we have bullish seasonality, bullish looking charts, some binary events. We have the 10-year yield that has just been ripping, which is typically bearish for markets, especially when you pair that with a rising dollar. typically. Same thing when when you have a rising dollar like this, gold, new highs. What is going on? What is going on? Right? So gold's pressing to new highs. What's silver up to? Silver, it's up 1%. We've covered that on last night's brief, how it was getting very, very tight here to see a potential pop. So I would imagine that miners are following suit here. They're up 74 basis points. Not that much of a move. Copper, let's take a look at copper. Is copper doing anything? Copper went... So copper, it went exactly kind of where we said we can find potential resistance, the declining 20-day moving average. So copper was coiling up, and copper is down slightly on the trading session today, but we did expand out of this and touch into that declining 20-day moving average. So we'll see here if copper picks up at all, because we do talk about that tight correlation that copper's been having with China, and KWEB was started up on the day today. It came in off a little bit. Let's take a look at BABA. BABA was up on the day. That came off a little bit. I had some in MLCO, and I took a little bit off this morning too, but that one's holding up rather well. I took it off more near the 200-day moving average, kind of where we're at right now. One of the positions that I have on. Bitcoin, crypto, seeing a massive breakout. It's on everyone's radar. Everyone's gotten super excited about it. The cellular to shift tool, I can pull that up. That was on a gave us a buy trigger, gave us a buy signal a few weeks back. Then the buy trigger came more recently, and then it switched over to a sell signal, but there's no official trigger. So we cover that on one of the market briefs because the price action, the absolute price action, looked quite bullish. Let me see if I can pull it up, see if it's changed at all. Oh, I don't even think we got the sell signal. My bad. Oh, it didn't even close there. So my apologies. It was there when we recorded it, but we had to wait till Sunday for the new candle to close. So my apologies. The sell signal, it was almost there, but it never came. So this is what it looks like. We did close above the zero line on the rate of change when the weekly candle closed. I talked about it on Friday. That's not when the weekly candle closes for Bitcoin. For stockcharts.com. So we closed above that rate of change, and you can see that we're still, we got our buy signal right over here. Sorry, not buy signal. We got our buy signal just before October basically in the middle of September. Okay, but the trigger actually came when price action got above the prior week. So it took a while to get there, and it was basically at 64,500. So from 64,500 was the initial trigger, and now we're trading up north of 72,000 when we're still on the buy signal, buy trigger, and so forth. So all systems are a go there. I do have exposure in Bitcoin and Ethereum. I peel some off. I think of it as just a regular piece of inventory. I'm not trading Bitcoin, the crypto itself. I'm trading it within my 401k account, at least the one that I execute into. So I used BITO, and I used ETHE. And then I definitely traded some of the miners, and I'm pretty much out of them. I think Cores was one of them, and then Mara. So Cores, we were talking more north of here, and then the reset up over here, and then Mara. Was it Mara? I can't even remember. So these ones are, somewhat setting up, breaking out. On the tight list, for anybody that's in the Discord, if you look at the tight list PDF, you probably should have noticed some names from the crypto space started popping up in there. So we had something like BTBT, and the weekly charts on the BTBT. We like to talk about stages of a market, right? So you have stage 1 accumulation, stage 2 accumulation, markup, distribution, and then decline, the 4 stages. And these crypto equities, they've been, is a BitX is better. A BitX is not necessarily better. It's more of just a trading vehicle. But you gotta really be careful with those products. You gotta really know what you're buying and how long you're holding it for. You're talking about just the leverage product. So those work for great short-term trading vehicles. Just you got to make sure your position sizing works very, very accurate on those. But they move the same. They move the same. It's just one's 2x. Okay, so BT is up 5.34%. But if I look at the weekly chart, stage 4 decline, is this an accumulation? Well, we do have the 30-week turning up, the 40-week, the 30-week, and the 10-week. Are we getting a little frothy here? Yeah, but we're also breaking out. So is this the early stages of a potential larger markup phase in crypto equities as Bitcoin is breaking out? And I think we got to think of that as a real possibility. Now, does that mean I enter right here? No. Do I think that there's more upside from here? Yeah. But I would prefer to see, more consolidations, so forth, setting back up, and then playing the breakouts with low risk. Because if you look to where prices came from, right, it's from here to basically here. We had a little consolidation, very choppy, but a very, very strong move in a very short period of time, right? 54%, right? So if you're changing that, just think that, if it can go up 54%, it can fall, 20% probably in a moment's notice. So I always look for the consolidations. IRN was getting some movement that still hasn't met its measured move of this potential double bottom. I think on the weekly time frame too, you can see how the 40-week has been sloping up. We got consolidated, got very tight here. We saw a big breakout. And even then, if people went and chased it up in these levels, look what price does. It pulls back, it sets back up, and offers a better risk to reward, which was kind of what we were pointing out from a while ago there. So a lot of these crypto equities, there's so many of them, right? A lot of them are flying today. So you got CAN. I don't even know what this is. These are like small little things. GREE, tight little price action. Boom, we're breaking out of it today. That's up 16%. LTCN, which is what? Litecoin. Another consolidation and breakout, right? You see the series of higher lows. Price action consolidates. It gets tight. And boom, we explode from it. And a lot of these moves are happening while the Bitcoin Sailor to Shift tool switched over. So here's ETH. ETH is a little bit of a pop today. Oh, quite a nice pop, up 5.4%. The title, the Sailor to Shift tool. Oh, are you talking about the title of this video? Yeah, I know. I thought I'd throw that in there. I'm just kind of trolling. The whole ICT thing, it's like, if it's your strategy, cool. But people, it's so funny because people put so much emphasis on their system. And a system, to me, their strategy is a buy-sell engine, right? It's a buy-sell engine. But people put so much emphasis on this when the reality of it is it has such a small importance when it comes, like, for example, if I were to take a bag of marbles and say, and we just said, okay, each one of these marbles is a trade, and you have some losing trades in there, you have some 5-to-1, winners, you have a 2-to-1 winner, you have a 5-to-1 loser. And the thing, if I just said, use your buy, you don't even need to have strategy, but if I just say, try to make as much money as you can every time I pull out a marble, tell me, and we pull out all the marbles and you say, oh, if I'm betting $1,000, right, or $10,000, I pull out a marble and you go to 5-to-1 loss. The betting strategy, the systematic strategy that you use for position sizing is paramount to any of this. You can look at your fair value gaps and be like, see, the market is prepping for this, or whatever the case is, or all the jargon that's being used there to sound intelligent, like they understand the market mechanics by looking at a candlestick chart, which is crazy, without looking even at the order book. They're talking about liquidity, and they ain't even looking at an order book. Hey, here, you want to see something? Like when they talk about liquidity, hey, watch. I'm gonna show you a trick. Okay? I'm gonna show you a trick. Ready? Level 2. Now you can actually see real liquidity. This is the market. This is the auction place of the S&P 500. You see orders hanging out here, moving, buying, selling, spreads. You can see real things. So funny. But if you have a system or if you have a way of approaching it using whatever terms you want, whatever strategy, cool. Then you focus on your position sizing and how you execute. But then more importantly, which is not talked about in that community, is the conditions of the market. Right? I've seen literally some of them talk about weekly setups and then they trade the 1 second or 30-second chart. Ridiculous. Ridiculous. Oh yeah, no, I'm really bullish here because it's on the weekly time frame. The market's just like you look at market net flow, it's like incredibly bearish for the day. The flow for the day is incredibly bearish. They're trying to like buy the dip because of the weekly time frame and they're on the 30-second chart. I don't understand what's going on here. But then you have some people that will use like the methods of like that stuff to find like support and resistance zones, but they articulate it in a way where it's just like, yeah, this is just a level I'm watching at, right? The proper way. So however you come up with your levels and your zones or whatever the case is, that's like step one of being a successful trader. Step one. There's, oh my God, it's just crazy how many different like things that are out there. It's wild. It's wild. So when it comes to like, so for me, for example, when I'm thinking about levels, like I'll look at like patterns, right? I'll look at patterns. But the patterns, what people don't quite understand, because a lot of people say stock market patterns don't work. I'd say, yeah, because a lot of them break down. But that's not what I'm looking for, right? All patterns in the stock market, to some extent, go through periods of expansion and contraction. That's what I'm looking for. When price action contracts in an asset, in a market, in volatility, in whatever it is that you're looking at, there's a high probability of it expanding at some point in the very near future. And if you can find a way to back into that risk and understand the strategy for your positioning, you can have an expectancy that's rather low, meaning that if you have 3 out of 10 trades win, you can still be a much more profitable trader than somebody who says, I have a 90% win rate. They're a 90% win rate only because their losers are significantly smaller than their winners, meaning that they take profits incredibly too soon, way too soon, because they're focused in on their win rate. But any real successful professional trader will, if you go to any firm and you're like trying to get funded or whatever by like a real prop firm, not like not a hack shop, but a real prop firm, and you're like, I have a 90% win rate. They're just gonna laugh at you. Okay, show us your strategy that's a 90% win rate. Oh, okay, cool. You can turn $1 into $1.01, but then when you lose $2. Congratulations. Hey, I can have a 90% win rate too. You know, don't ever think that you have like solved the market. You haven't. You're never going to solve the market. It's not going to happen. The market changes. It's made up of so many different things from a global perspective, right? It's not just in a state, in the country. It's global. You have institutions, hedge funds, retail, investors, passive funds, mutual funds, ETFs, money managers, short-term traders, high-frequency traders, swing traders, momentum traders. Okay. We're pumping up there to the 0-day level. So when I look at markets, the levels that I like to look, I look at some patterns, so like I was saying, some support and resistance. But more importantly, I look at levels where the market is focused in on, right? Like I find that to be more important. If the market says, hey, 5850 is an incredibly important number because that's where a lot of attention's at, I'm not going to go and say, oh yeah, but my level is 5840 because of my line. You know, or because of this candle on the 30-second time frame or 30-minute time frame or 4-hour time frame. I don't care. I would much rather prefer to look at a legitimate level based off of where people are actually reaching. So that's why I look at gamma levels. I look at 0 date levels because that also shows incredible action. Look at 58.45. We came into it. We push away. Oh my gosh. We came back into it, right? Let's take a look at the 0 date chart. Let's take a look. What's it look like? Ready? Boom. 0 date. You tell me that this level is not important. 58.45. It's the main focus point for the day. So chances are, can we break from it? Cool. Yeah. But where are we going to go? Nobody's reaching out further. Okay. 58.50. Okay. We're right there right now. 58.45, 58.50. So if we come up, we'd probably be in this range for a minute. And then the market's going to settle in. Oh, kind of like it did there. Okay. So why would that be? Why would traders not reach out further? And they might, right? Look, it's 58.65. So if this starts growing in size and you start seeing this come in, traders are getting a little bit more bullish, right? And if that's actually the case, maybe they see something, taking place more positive when we report earnings. For example, for Google, because Google's going to move the market. It has the market cap to do that. But right now, what this tells me is, yeah, the market's kind of in its happy place right here. We can go a little bit higher, but we can bounce back down. We can come back in and so forth until we have some more clarity around earnings. That's how I read it. That's how I interpret it. And how I interpret it from what's currently happening, that's the narrative, right? That's the gap. That's the narrative. And the narratives is what's always typically wrong. This is data. I'm the narrative. So when I look at this and I don't have a clear idea of like, hey, should I go long right here? Well, my thought process is, no, I'm not going to go long, but I am going to hold on to my positions that I currently have on. Because nothing is screaming to me to get out, right? Just walking through my thoughts. Oh, the coffee is so good. I needed some coffee. Let's take a look here at the chats. What do we got going on in the chat rooms? Pop it off. What's up, EJ? GME is moving. Oh, the green sack. I was wondering what you're talking about. My bad. I just saw the Twitch chat there. It's a shirt. That's a shirt. That's funny. Once again, I'm not a fan. Well, okay, I can't really critique ICT. Oh, by the way, ICT. More on ICT. They are concepts, right? That's what's even said. ICT, smart money, concept. The problem with concepts is they leave room for interpretation. A lot of room for interpretation. My point here is if it leaves too much room for interpretation, you're going to struggle. And that's why, still to this day, even with the power of ICT, you have 90% of traders lose money still. 95%. But then it goes to, oh, well, they don't know enough. They have to watch these long videos and learn about all this jargon and misuse terms like liquidity and order blocks without even looking at the order book. How can you call something an order block when you don't look at the order book? Oh my gosh. It just bugs me so much. But here's the thing. What's good about it is it brings in a lot of new traders. A lot of new traders, they get to learn and see the markets, understand the markets, create their own strategy, and learn over time. My thought here is they'll go through it, they'll realize that like, wow, there's actually much more significance to understanding position sizing and actually looking at real data that actually market participants look at. Versus kind of just like flying by your heels and looking at candle wicks, right? Are they important? Do they show some sort of emotion? And yes, absolutely. But then there's context that can be added to all of this. And the context that you can add, the layers that can be added on, you can use concepts or you can use data. And here's the real fact. is no matter what strategy you use, you are guaranteed to lose money at points. Okay? So, if you focus on a 90% win rate, you're like, oh, this guy always wins. I'll guarantee you that equals a very, very, very small reward. A VVVSR. I created my own ICT term. I got a 90% VVVSR. Very small risk to reward. It means that their rewards are significantly smaller. And if they want to keep their losses tiny, they can do that. But that means if their losses were really tiny, that means that the rewards would be probably even tinier. Because it gets stopped out more. Right? So let me draw something out for you. Here is my reward, but here is my risk. Price action is right here. Do you think that if price is right here, we're going to hit my reward before we hit my stop loss? Right? You'll probably be like, yeah, that makes sense. I'd be like, yeah, cool. So let me do this 9 out of 10 times, and I have a 90% win rate. But if I lose, that is 1 R loss, 2 R loss, 3 R loss, 4 R loss, 5 R loss, 6 R loss, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So I won 9 in a row, but I lost. Sorry, 9. I won 9 out of 10 times, but my one loss was a 16R loss. You see? It's crazy. So what do you do? You don't focus on win rate. No matter the strategy. It doesn't matter if it's ICT. It doesn't matter if it's mine. You just don't focus on win rates. It doesn't matter. Position sizing strategy is what matters. Sizing matters. And at to some point, for people that want to know more about position sizing, I might put something together for that. I've had a couple videos, but I think I want to get more intricate and talk about, martingale, anti-martingale, optimal F, Kelly formulas, formulas that you probably shouldn't be using, and get more into the depths of all of that, that gets into the more technicalities and the calculations and the boring stuff. I feel like some people prefer like that. But also, I don't really get too much into that jargon. I know if I talk about gamma, right? Gamma can be very jargony because it already sounds jargony. But when I talk about gamma, I talk about it very simple terms. I don't like to, talk about it being the gas pedal, the throttle of delta, and get so into the mathematics and the intricacies of it, because then it kind of overwhelms people. And on top of that, you can be an engineer and prefer to know all of that stuff, or you could be like me and be like, yeah, you can have an understanding of it, but also you don't need to know all of that in order to be able to successfully trade. You don't. You don't need to know the calculation of an RSI, a relative strength index, to understand what a bullish and bearish divergence is. You see what I'm saying? Now, you may need to understand the RSI calculation to understand an oversold or overbought condition. Overbought condition isn't necessarily bearish, right? Because then you might be like, oh, it's overbought. That means it's going to sell off. Actually, rewind the tapes. What is the RSI? What is the index? What is the calculation actually interpreting here? Right? If you go into school and you have a class full of students and everyone gets an A on their test, that classroom's overbought on good students. So do you think all of a sudden it's time to fade them? Oh, they're going to fail the next test? No, chances are they're going to continue to succeed. All right? So there's different ways of interpreting data. That was a good analogy. That was a good analogy, in my opinion. It was. That was a good one. All right, let's take a look here. Seeing all these comments flying. Yeah, we can look at some individual names. It's not fair. It's the equivalent of support and resistance. Sure, the footprint chart and the order book is great, but the chart can tell all that with just looking at, no, it can't tell that with looking at the order book is, no, that's not how it works, Mike. That's not how it works. The order book is showing you what's in the order book. The candlestick chart is showing you what's filled. It's the print of the auction. The order book, you take your blindfold off and can see the actual people in line at the auction saying, I'm going to buy here or I'm going to sell here. They're completely different. Okay, let's take a look at the markets. Market net flow, bullish. SPY, still looking bullish. Not much movement since we started to chit chat. Since I started to chit chat, but yeah, it's above a rising 5-day moving average. Price action was getting rather tight. We still have a wide open daily expected move up here, 584. This level is not just a level that's drawn on the screen. It is a level based off of the options market. It's a level of risk. An area, a range of risks that the market price is in. Okay? This red zone up here is just highlighting the difference between the daily expected move based off of 0-date options and the VIX daily implied move. And the VIX is a calculation from the options chain of the S&P 500. Now, the S&P, now it's not using 0-date. Or if we go to the SPX, it's using options out further. It's using options out further through the chain and gives us a larger range of implied volatility. So if you go to the VIX and you look at the percent where it's at 1936. So it's at 1936, right? You can look at VIX, you can look at VIX futures, whatever you want to do. So understanding this, so if the VIX is at 1936, you can do a quick mathematical calculation, the square root of 265, which I've already put together an indicator that does it for you. So I'll go to SPY, and I'll go ahead and I'll apply the vol bands. Add it. Apply. And then what you'll see here is so it's calculating for, let me go to the intraday so we can see the current levels. There we go. Let me make sure it's the right one. Yes. Okay, so it takes the VIX, it gives us an implied move. So when the VIX is at that level, it's basically saying the daily implied move is at 1.22%, which gives us an output of 588.07 and 573.59. 588.07, 573.59. Did I get that right? 573.59, yes. So when I draw these little levels out on my screen, it's just telling me these are the range of risks. One is based off of the VIX volatility index. One is more near term, the daily expected move. In my opinion, they're both important. And really, I started doing the VIX daily implied move because the VIX is elevated. It's been rather elevated, and we started breaking through these daily moves more frequently in recent trade prior to this kind of sideways chop. Not sure why you don't want to grasp that concept. Maybe explain the concept again, maybe, and then I'll wait. Which concept? Sorry, I go on these tangents, Mike. And by the way, Mike, I'm not saying that it's. You got to understand when he says fair value gaps, this is all stuff that has been said and done before. So it's a repackage of supply and resistance. That's all it is. You can say it however you want to, but you can go through the history books and I can prove to you that is the case. Okay? So you can redraw lines and do it and say, oh, there's this wick and there's this, that. But I am telling you now, it doesn't matter in certain market conditions. It doesn't. It just does not. And there's still going to be failures. So the fact that people argue so much on a system and words being used is crazy to me. And they get so defensive about it. But yeah, the words like using the word liquidity and looking at a candlestick chart, right? Oh, they absorb this buy side liquidity. Oh, it's jargon. It's not the correct words if you actually understand market mechanics. So so when you go on YouTube and you go look at some streamer that's streaming using ICT concepts, they are throwing so much crap at you. There's nothing wrong with just trading candlestick charts, by the way. You can do that just fine. There's plenty of traders that do. High-end traders that just look at the chart. Nothing wrong with that. All right? And I could literally show you right now what some of the high-end traders do that I know work at huge prop firms that trade big prop firm money. I can tell you exactly what they do. And you can call it, oh, that's ICT concepts. Well, that's not what he calls it. You know what I'm saying? Yeah, no, I'm not necessarily engaged. Like, how do I put this in a way that people can understand? I think like everyone understands where I'm coming from. It's not a critique on the system and the strategy. It's more a critique on the misuse of terms and the understanding that you should really understand what it is that you're saying and how there are actual tools that provide you the real data versus the concept. So I get that, oh, see, there could be sell-side liquidity here or an order block or whatever, okay? Well, really, price just extended and it took a little bit of a retracement. Like, you could also say that, right? That's why when I talk about like technical analysis and stuff, I like to keep on the 5 principles of technical analysis. This is learned from, the books. Everything that I talk about, it's all stuff that I've learned through people's various random strategies, through just market mechanics stuff. You name it, right? What has been said has been said. What's been done has been done. And the market, this is what's so interesting is, and this is what also disproves a lot of things, is when people say this is how it always is, and they've done it for years, but yet the market structure ultimately changes. Like, for example, zero-date options are new. Like, I feel like people don't quite understand that or grasp that, right? They're new. Very new. We're talking a few years that they started hitting the tape. And now, people don't even realize that most products don't even have daily options, right? Some do. But then weekly options are fairly new too, right? So if I go into IWM, look at, you got one. Get out of here. You got one. Like, does anybody know this? Like, do you see this? How there's a 0 date, a 1 day expiration, 2 day, 3 day, 4 day, 6 day, 7 day, 8 day, 9 day, 10 day? That finalized this year? Does anybody know that? It was Monday, Wednesday, Friday. Prior to that, it was Fridays. So to say that all this is taking place and like, oh, these concepts, these whatever, but yet the market is actually changing in real time. New products are being added all the time, right? People in 401ks, they a lot of these products, they can't short in their accounts. But now there's products where they can literally leverage short by being a lever, like an inverse ETF. So the structure of the markets are constantly changing. They're getting more volatile. They're moving around more. And if you don't take that into consideration into how your strategy operates, meaning that every strategy works in various conditions, right? Your ICT strategy will work very good in a very specific market condition. But when market conditions change and you're still using the same time frame, you're not widening your stops, you're not adjusting to volatility, you're going to realize that, whoa, these are getting whipped out way more frequently. And the same thing goes for a swing trading strategy or a breakout strategy. If you don't understand the market conditions and when they change, you're going to be surprised. IWM's coming a little bit here, by the way. So the five principles, right? The 5 principles that I stick to when I kind of talk about markets are these, right? These are the basic principles of technical analysis. Price action equals emotion, right? Price action is emotion, right? You'll see large candles in one direction. Basically a big green candle like this would be a very bullish, greedy candle. And sometimes when you all of a sudden see a smaller candle and a smaller candle, you can see the emotion waning. The authority of the candles are drying up. Then you can have big red candles. Boom. Very authoritative, fear-based candle. And then you can also read it when those candles start getting smaller like this. Like boom, you can say, wow, okay, the authority of each of these candles are actually slowing. The momentum of the fear is starting to wane. Then the king indicators, right? All indicators are based off of typically these 3 things. So any overlay, anything is based off of a price action, right? Volume, and then volatility, which is become probably the leader of importance in these markets. Because volatility will help you with position sizing. Now, volatility, this is where people get it confused, is volatility. There's 2 aspects to volatility. There's HV, which is historic volatility, and there's IV, which is implied volatility. And implied volatility is the market's forward-looking levels of risk, what it interprets for a risk. So, going into Google earnings, people's like, am I going to be bullish? Am I going to be bearish? It doesn't matter. Be bullish, be bearish, be whatever you want to be. But understand this, that the market's pricing in about $11 worth of risk. So one standard deviation, think of it, easy terms, statistics. 68% of the time will probably finish within this range, and it usually breaks it. But typically what I think when I go to earnings is we're going to tag one of these. We'll tag either an $11 higher or $11 lower. And if I could if there was a way to bet on that, if I can just say, I bet XYZ that we're going to tag this implied move, either upper or lower, I would take that bet every day, because I know it's going to happen. And if it doesn't, it's going to be what? 10% of the time that it doesn't? Maybe, right? Maybe 20%. Still, it gives me 80% probabilities. I would take it all the time because that's trade expectancy, which comes back into, many points that we were talking about today. It's all about expectancy per trade. All right. We're dancing. There's Moonraker. I'm not even repeating that. That's hilarious. The 10 commandments. That's good. The last one there, the last comment there was pretty funny. Okay. Okay. That's okay, newbie. Is that that's funny. Well, okay, so you follow a volatility trader, and he said, okay, that's a good point. So if you follow a volatility trader and you ask him if zero-date options change his strategy on the back-end test of 225, he claims no, but I don't know if it does. Well, it depends on his actual volatility setup, right? Zero-date, it ends the day of, right? So it ends and it claims it's over. So he might not be an intraday vol trader. Now, if he is an intraday volatility trader, I feel like that would affect him a lot more than potentially if he's like running a vol fund, right? it would be a lot different about it would be the intricacies of whatever it is that he does. Now, volatility traders are another level of complexity. These guys are, if they trade volatility, I promise you, they are the smartest market participants in the market. Okay? Hands down, any volatility, and I'm not saying like they trade SVIX, right? I'm not saying that. I'm saying if you're talking about somebody who trades VIX futures, okay, professionally, I guarantee you these guys know more than everybody about market mechanics. These guys are insane level of intelligence. And by the way, even that insane level of intelligence and understanding of markets and market structure and all this stuff, they have trades that fail. They just know how to manage risk is what it comes down to. They're risk managers. But yeah, volatility people, man, they're a whole nother level. They'll talk for 2 seconds and you won't understand a word they say. It's crazy. And their level of the mathematics of what they do is just like, poof, it's crazy. I can't do that. That's not me. But if it's you, congratulations. Holy moly. Holy moly, these guys are crazy. And by the way, VIX futures, these things are insane to trade. Don't even mess with the VIX futures. It's crazy. I think they're making another product too, actually, for trading volatility here. I think CBOE announced it. I can't remember. Oh, I like these vol control funds, man. They're brainiacs. There's actually a good guy on Twitter to follow who tries to make it like understandable. I forget his name, but he's a pretty big guy on Twitter, and he is definitely a professional on the volatility aspects of things. It's pretty cool. Hey, what's up, Left Set Match? I'm glad that the indicators help you out, or that you got them working. Oh, so your indicator probably says 58878, so I'll show you why. On SPY, let me go like this. Wait, on are you using TradingView? My guess is because it's giving you the next day. So the next day hasn't settled yet. So today has to close, and then you'll have those numbers. But if you go in the intraday time frame, Love Set Match, you'll see that it's actually like, so intraday will show you the current day, 58807. But if I go to the daily time frame, it's pointing out from where the vol band is for the next day based off of the current VIX. So it's going to be up, it's going to move up and down until the closing price. And then you get those levels for the next day. That makes sense. One of the other principles of technical analysis here, the trend is your friend. Doesn't mean you can't trade against it. Just know that if you're trading against it, your strategy typically has to adjust, right? The way that you approach it, the trade, the position sizing, the length in trade, all those things change, right? If you try to swim up a river, it's a lot harder than swimming with the current. So the trend is your friend. Markets alternate between range expansion and range contraction. That's one that I talk about all the time. This is the kind of the bread and butter here, is if you can really identify contractions, it doesn't matter if you're right or wrong. It means that the risk is tiny, and then if you get the breakout and volatility expands in your direction, it makes up for so much of the small little risks that you've taken. And then most importantly, technical analysis, ICT concepts, they don't predict price moves. It's a tool to help you forecast a potential price trend and a price movement. It's a way to forecast. It's not a way to predict. There's failure rates. And the only thing that can really help you succeed and get through failure rates is a PSS. Position sizing strategy. You like that? There's another cool acronym. Okay. Oh my goodness. Oh, okay, no. Oh my gosh. I thought I was on, my bad. I was on the wrong scene. I literally thought that I was in my newsroom still this whole time. I would have sucked. That means my screen would have been so tiny. what's the name of the indicator again? I call it vol bands, but I think I'm changing the name to iVol bands. I posted, so TradingView, they pulled my script down for whatever reason. They basically said that like the description wasn't clear enough, and some of the code that I used in there, basically, I don't know what they said. They said basically I had to just rewrite my description, but they gave me so much notes. I'm like, and then a lot of it I even like went through. I'm like that there's no other way to write this. How can I not do this? And it didn't make sense. And then they responded back and they're like, well, then you have to be very clear about, you know, it in the description about it not being a predictive tool. I'm like, and I'm trying to explain to like the coder on like what implied volatility is and why we need it to forward look. That's why I just posted the script, the code itself. And I said, here you go. Pop it into your thing, and if you have a problem with how it formats, put it into ChatGPT and say, format this correctly for TradingView or whatever. Kem Carson talks about it. Oh, that name sounds familiar. That's a vol trader, right? Might as well be another language. Yeah. That's not the one that I'm talking to. The guy, I think his name is like Chris Citadel or something like that. No, I'm getting that confused with the bank name. Citadel. Chris something. Citadel? I don't even know. I'll find out. Let me find out his name. Is it Chris? It's not Chris. My bad. Oh, it is Chris. It's Chris with a K. Chris Seidel. Co-CIO of Ambrus, an exotic derivatives volatility tail risk hedging fund. If you want to follow smart guys, there you go. Follow that guy. Exotic derivatives volatility tail risk hedging. Sweet. That's intense. Do I have a link for the Thinkorswim Swift? Thinkorswim Swift? Yeah, I'll pull it up for you. And then we're gonna pull up some random names here. Let me see. I gotta open up Discord. I posted it there. Oh wait, no, I posted it in X. Didn't I post it in X? Give me a second. All right, John, I'm posting it in the chat. There's the vol bands indicator, I think. Believe that's it. Second stream today, bashing ICT. I didn't bash it. I pointed out actual legitimacy. It might sound like bashing, but that's not bashing. It's correcting. And people got to understand that. You're welcome. Okay. We are. Market ain't doing anything today, people. It's just waiting. So what are we doing? There's that 58.45 that we talked about an hour ago. All right. So what did we say about 58.45 and this 58.50, right? We were talking about factual levels, okay? Factual levels. Where are the markets kind of focused in on? We went to the 0 date and we said, obviously, this is the data. It's saying 58.45 is the call wall for today, maybe 58.50 in this area. That is where the exposure's at, and nothing is going on above that. So for the market to start going out further and actually hold it, we'd want to see traders really reach out further. That's not the case. So This is what the data is. Now we create the narrative. The narrative to me would be what? It would be basically saying that I don't see the market going much further than this. And that could potentially be because the market's just waiting for earnings, and then it can make its move. Now, what would make me change that narrative? What would make me change that narrative is if we get back above these levels, and then all of a sudden we start seeing people reach out further. And then maybe perhaps market net flow turns back green and gets more bullish, right? It's not really bearish right here. It's just not crazy bullish. That right there, if that happens, if that's the case, if we start reclaiming this stuff, then I would be like, okay, perhaps it's giving us that opportunity to come into the daily expected move of 544.33. But not now. Not right now. EJ. Oh, second stream that said that? That's funny. Okay, let's drop some tickers in the chat. We'll pull up some individual names. So once again, when it comes to market conditions, we're gonna revisit that, because it also, when I talk about these individual names that could be setting up, when I talk about these individual names that could be setting up, the market conditions are in a place where they can potentially change pretty drastically fast. So I'm not looking to like go crazy here on any new position. Right now, I'm just kind of managing what I got on. And by the way, I speak from a place where I'm actually showing, like I am now verifying any trade, or I'm now verifying results, right? I go through the United States Investing Championship. So I'm not talking from a place where like, I'm just saying stuff to say stuff. The stuff that I say and present, I'm doing it. Now, there's many videos, so to like I haven't taken the time to compile everything in a way that I can present it in a single, course or video or anything like that. I haven't done that. So it's a lot of different things that we discuss, talk about, but I keep it really understanding, very, very simplistic as far as market conditions go. And this, let me make sure that I'm not showing my bank account info. So here's the P&L for, Jamtani, the IVOL bands are not the vol bands, IVOL bands. They're not there in trade they're not there. They're not in TradingView right now because TradingView took them down. So I posted the script in Twitter under my highlights section. So if you go to my highlights section, you go to the TOS script and you go to that thread, you open it up, you'll see that I posted a Google Doc here. Here's a Google Doc. I'm going to just give it to you right now. Here you go. There's the link. Okay? There it is. You open that up, or you go to the Google Doc, and then you copy that script, and you could post it in the script to have the indicator. The problem is, I think that the formatting gets misplaced a little bit. So what you can do is just throw that code into ChatGPT and say, hey, format this for TradingView. And then just copy it from there and then put it in. That should do it. Okay. Okay. So this is the P&L. This is the P&L curve. Now, there's been periods of times like where it goes sideways for quite some time, right? And this is typically when volatility typically increases. Now, the reason why I'm showing this goes from October 27th to October 28th, and then it's definitely in the United States Investing Championship, so you can verify the results there. I'm up around 50% year to date. And by the way, I'm not going to win the United States Investing Championship. That's not the goal. It is to get verified and just be out there. But I don't use leverage, right? To get 400% returns, you got to use some leverage, right? At least that's what I would imagine, is they're using leverage. So I don't have, the account that I'm trading is also bigger than what you can enter the competition with. You can do this competition with $20,000. I'm trading my accounts, my full account. And I'm not using margin or leverage, right? Sometimes I'll trade like a small position in like a TQQQ, for example. I hardly trade that one, but sometimes I'll put in that. But the thing is too, I can't day trade that account either, right? Without getting strikes. So the on the 401k, for whatever reason, it doesn't allow me to do that more than a couple of times, or it has to have the cash result, like it has to have the cash. What the hell's the word? What's the word? I don't know. I forget. I'm drawing a blank right now because I'm all over the place. But basically, in short, it has to settle before I can make that next trade. So I have to swing trade the account. And the reason why I'm saying that is because you can have a really good trading, experience and not use leverage, not use margin, not day trade. You can do all of that. Okay. Let's take a look at some of these names. Settled. Thank you. Yeah, thank you. It came to my mind like last moment there. Appreciate that. Okay, so we got Tesla, we got Google, we got X. I'm going to write these down and we're going to go through these. I'm writing them down right now. mRNA. Prince, is Kins like, do you mean pins by any chance? Snow Crocs? Snow Crocs. Crocs is coming out with a new product, right? A new shoe. They're like fluffy pillows. They're pretty funny. They actually look comfortable. They're like slippers, but they're like fluffy. SCCO. I actually think I have a position in SCCO. Let's check up on that one. Backflip. I don't really have the data on that, so I don't really have the data on that. But if you want to learn more about like the VWAP or anchored VWAP, I'd suggest reading like Brian Shannon's book. Maximizing trading gains with the anchored volume weighted average price. One thing that I can tell you though is futures return to VWAP before major events. My thing with the VWAP is to actually apply the anchor VWAP to the major event, because you got to understand the VWAP is volume weighted average price. So when a big event occurs, you get a spike in volume, and I want to know if this big spike in volume, if people are in the water or under the water on that specific spike in volume. So you can still have the daily VWAP up, week to date, whatever, but on a big event, I don't trade into the big event because that's too binary. And plus it's too much risk. So I'll let the event pass, I'll apply an anchor volume weighted average price to it and see how price interacts with that and sets up a good risk to reward. Okay, IRM, Berkshire, BRKB. Canopy. What's Canopy again? Is that like a Canopy Growth is, what's the ticker symbol? CP something, I forget. I can probably look it up, that's fine. Okay, let's go into some of these things. Okay, so Tesla. Adobe. Well, that's one I haven't checked for a minute. Yeah, Adobe. Let me get rid of, or we're going to do daily time frame and we'll go into the 15-minute. Actually, you know what? I'm going to change it up. I'm going to do actually multi analysis here on these names to give you a good idea. We'll do side by side. Okay. So we'll go daily and 30-minute time frames just so we can see kind of like the 5-day moving average and you know where it stands within this stuff. All right, so Tesla. CGC, thank you. Whoa, multi-analysis. You know what I mean. Oh my gosh, dude. Just it's always Moonraker. Calls me out. Multi time frame analysis, whatever you call it. Okay, so Tesla. Yeah, this, okay, so Tesla reported, right? Tesla reported earnings, huge move, huge follow through. We're pulling back in right now. I love trading powerful earning moves, right? Power earnings, because when you have a big move like this, chances are that there's going to be follow through. Now, I don't just buy and then, you know, hope and pray. I look for consolidations, for price action to consolidate and for volume to dry up. So what we're seeing here is 2 big days, boom, boom. And then you see big volume, right? Makes sense, earnings. Now volume is starting to dry up and price action's coming in a little bit. So we can look over here and say, okay, so how would we approach this? Because we don't know if it's going to come down into the 30-minute time frame or undercut that and so forth. The only way that you can really identify a potential move back up is if you see strength. Okay, and one way you can do this is you can, I guess it's one way. You can apply just anchor volume weighted average price, right? Boom. So you can see the earnings anchored volume weighted average price. Boom, we held it the next day, or we opened up on it that following day, and we started seeing move. Now we're getting kind of underneath it. Okay, so one might say, okay, if we can reclaim this, that might be an ideal level to watch. Now, if price comes down more here into Tesla, into the 5-day moving average, you'd want to see, obviously, instead of just buying the dip, wait to see if all of a sudden we start to see strength from it and it puts in, you know, a higher low and starts moving up. But even after that point, just pay very close attention to the earnings anchored volume weighted average price and where it's at, because you'd want price to get and reclaim those levels. Now, you don't know how it's going to play out, right? We can gap up there tomorrow and it could be on for the races. So another thing you could do is potentially apply an anchor volume weighted average price to the swing high and kind of watch how price does this. So if price comes down, maybe it snaps back up, it gets rejected, it comes back in and starts doing something like this. You can potentially play it like this and then have an idea of where your stop can be. And if you look at the daily time frame, what would that might look like? Well, maybe it's just a couple more candles of, you know, sideways price action. And then it looks more like a, you know, a flag of some sort, and then you play it, boom, to the upside. So I think that you got to be a little patient here as we're seeing, you know, we're seeing a little bit of weakness on the day, but it's really the market is digesting. And unfortunately, doing these analysis this way, you know, you're going to have times where it just gaps and goes. Like that's going to be the case, but just have an idea of where that gap might be into certain levels and where potentially it can fall down too, right? So even if it were to like, you know, undercut this 5-day moving average and boom, and then start doing something like this, find out where the 5-day moving average goes to, find out where these anchor volume weighted average prices are at that time, right? And then see if it sets back up. So it could be a couple of days before we see a setup. And when I see things like this, I prefer to wait to see a larger, like kind of consolidation and so forth to play. But right now, it's just consolidating. It's gigantic move in a very short period of time. So that's my thought on Tesla. That's what I'm looking at. Okay. WDC, I'll look up WDC too. I want to do this a little bit quicker because there's a lot of names. And also, I just want to keep an eye on the market because we're up 15 basis points now. Let me update this, see if anything's changing here. This one grew, 58.20 kind of grew. Weird. Okay, so we are starting to turn green again here, which means that's a positive sign. We're starting to see more cumulative net premiums for calls. Nice little uptick there. Puts kind of flatlined. That's the divergence is growing between these two, which is the cumulative net premiums of puts and calls. That's bullish. And then price actions moving in the direction, causing convergence to go green and momentum to probably strengthen here. So looking at this now, 58.45, 58.50, not much reaching out still further. So when I look at this, I want to pull back up the gamma chart, and we'll come back to this. Get up to that 58.50 as a potential level here to watch. So if you're trading, I'd be looking at that 58.50. And if nothing really changes from this 0 date level still, that would tell me that, we could see the pop, but it could potentially come in. And on the upside for SPY, if we're going to really see this market get going and start breaking out of this consolidation, 584.33. And if I go over here to the 0 date and look at the current change, there is a big red bar over here at 584, which happens to be the daily expected move. Let me look at the strike in total. 584 is kind of a focus area. Don't rule it out. That might come a couple bucks higher. Okay, so bullish divergence, bullish convergence, bullish levels there. And then on the SPX, the 0 date, it's not much of reaching out further. So it's kind of one of those coin tosses. If anything, it's not really bearish. So if you're thinking about trying to attack it from the short perspective, this would tell me I wouldn't even do that, because if you do this consistently over time, looking at a bullish market structure like this, you're gonna lose more frequently than you're probably going to win. But you will take eventually some wins. But with structure like this, you'd be fighting, and I'm not much of a fighter against the current. So if anything, I would be looking to just keep my positions on. I wouldn't be sweating it and be looking for potentially more upside. And then we'll see what Google wants to bring, which I still have, by the way. I did load my 401k up. I still have long positions in some stuff. Okay, let's go back over to the analysis, and we'll go back to some of these individual names, and we'll check back at this if it comes into that 58.50, which it looks like it's going to do. No. Cancel. It was side by side. Side by side. Yes. Okay. Let's see. I came here for ICT concepts. That's awesome. Where did my notepad go? There it is. Okay, Google. Okay, so Google, right? I'm not going to spend much time here because, very simply put, oh, do I have the implied vol bands on Google right now? I forgot that I had these available on right now. Okay, Google looks bullish. It really does. So we broke out of this consolidation, and we're coming into a prior kind of area of resistance or prior area of supply, right? This prior area of resistance, and we're moving right into that level right now. We're holding above the anchor volume weighted average price from here. And I think the last time we talked about really Google on the live stream was when it was breaking this just downtrend. Okay. So a measured move can bring us easily up to here. Now that's the analysis looking at the daily time frame. The problem here is that Google is running earnings right after the bell. So Google after the bell, look at the implied move. It's increasing in volatility, right? So the implied move percentage is, the IV is about 90%. The implied move is $11.22. So wherever the price action closes for Goog, gosh, I'm gonna get this out of my screen. All right, wherever the price action closes for Google, you go like this, like say for where it's at right now, you go up 11 bucks, 11, and what was it? $11 and some change. I'm just gonna go $11. Okay, and then go down. Oh, you guys, I got to get off here in a little bit here too, because I have somebody coming in for the house to walk through it to do some of the work. Shoot, I forgot about that. That's going to be in like 10 minutes. So I'm going to go through these names quicker. Okay, so Google is pricing an implied move up to 180 and or down to 158. This is the risk that the market is pricing in. It looks, I mean, I feel like earnings are going to be fine. They're going to be good on these big tech companies, but we'll see what guidance looks like and so forth. Now, if this is the case and we get a nice big bullish candle, once again, I wait for consolidations and I try to play the move up further if that's going to be the case. But overall, you potentially have this inverse head and shoulders playing, and the measured move would be up to here, and then the implied move is pretty much up there too. So that's Google. X, is that steel company, right? I'm not huge on trading these material names because you can have something come out and you could just see a big crazy day like this. But yeah, it's kind of just all over the place right now. I mean, if you're trading this and just in the shorter time frame, you are above this rising 5-day moving average, and we're reclaiming that level and starting to gain some strength here. So if you're looking shorter term, you can apply a anchor volume weighted average price to this day's low. Prior day's low. And kind of watch it from here, how it's kind of consolidating. So if you're just trying to play in the shorter term, you know, this would be your risk to potentially reward or up higher. Now, if you're trying to expand it out a little bit further than that, I mean, you could in theory do the same thing and say, oh, from this swing low, see where it's at, or even potentially this big day here, how it's held. Overall, though, we are just kind of consolidating here, kind of an outside day. I'm not like a, let me see here, zoom out a little bit. Make this smaller. See if there's any just random trends here that I can keep an eye on. There you go. So it does look like it's kind of just following this little downtrend here too. So perhaps if we start reclaiming these levels and it starts breaking above it, that could be an idea of where you can set up some risk and you can play actually somewhat of a trend break. I'm more of a fan of horizontal trends, not a huge fan of the diagonal trends, but when they have like really close touches like that, it is worth noting as price moves up to these levels. mRNA. The daily trend is just garbage. I don't really trade this stuff. If I do, it's very short term, right? So if I look at this, it's just in a huge downtrend. So if you trade this stuff, it'd be for me to trade mRNA. Like I'll trade stuff in a downtrend. I'm totally fine with that, but it's going to be on the shorter time frames because I know already that I'm fighting the river, right? So the river meaning, do I have the averages up? No, I don't have the averages up. Let me just pull it up over here so you can see. Okay. If I go to the daily time frame, you're underneath a 20 declining, 50 declining, 200 that's turning over. And yeah, you may very well snap up at some point, but that's why on these larger scales, I prefer to use these smaller time frames like the 30-minute, 15-minute, whatever the case is, and then watch that 5-day moving average. So I'm looking at this here, and I'm saying, okay, well, it's actually starting to turn around. We're starting to see strength. Boom, we're starting to see strength, a little bit of a pullback again. So if we start pulling back and start to see strength again, yeah, maybe you can play it up again and try to get back up to that 57 for a shorter term trade. I think that there's a lot of other opportunities in the market. If you just are bullish mRNA for like a weekly perspective, or you think that, oh, it's, sold so much that it has to go up, just understand that things go sideways for a long time. So if I go to ARC, I mean, let me just show you. Go back, I'll go to the weekly time frame. Oh yeah, this is the bottom, right? Well, the bottom, yeah, congratulations, it went up, but it also went sideways forever. So I don't like my capital thinking that I can get locked in a position like this. And who knows if mRNA is going to snap back all the way up, but more likely or not, it's going to wear people out based off of the 4 stages, right? You have accumulation, markup, distribution, and then decline. And then after the decline phase, you typically go through an accumulation phase. So it's very rare to have like V-bottom markups. It's not impossible, but I'm just using these as an example. So if I go to mRNA on the weekly time frame, I mean, look at it, right? Oh, you thought this was the bottom? No, sorry, it wasn't, right? So even if it goes like this, I mean, I don't know your length of time of how long you plan to hold it, but that's what I kind of consider. Now I know that if you look at some RSIs and you look at MACD and you'll see divergences and it looks like it could potentially turn around for a shorter term trade. That's to my point of why I like the shorter time frame, right? You start to see how it was in a downtrend and then it's starting to turn here, right? So I think that this sets up ideally for shorter term trades to the upside. But then I would manage it from the smaller time frames, not the daily or weekly, because I don't care about this particular name in a trend like this. I just wouldn't feel comfortably if I took a full size position and just held it, because I'd have to monitor it. It's just constantly in a downtrend. I don't like swimming up the river there. You can apply an anchor volume weighted average price to this prior swing high. See if it comes down, see if it doodles around that, and see if we can start breaking above this at some point. Could be another one, another way to look at it. Okay, let me go to SPY. SPY is holding up good here. Getting a little bit of a pop there. SPY at high of day. Qs. I want to see Qs because I do have a position in Qs active right now. Hell yeah. Qs at highs of the day. Let's take a look at the gamma and we'll get some more of these names before my guy comes and I got to do this. So gamma levels. Where are we? We're right at that 58.50 level. So we're kind of above it. Let's see if anything changed from 0 date. No, not really. Market net flow is still screaming though. So market net flow is still incredibly bullish. Not too many traders reaching out here from the 0 date perspective. But let's go into the net gamma and see if anything's changing there. Hmm. 58.50 is right here. 58.75. Let's go to SPX. And just see here. So SPX, so understand that SPX 58.50 is right up here. So maybe watch this level on SPX. This is by CBOE. On this chart, I have it on actually the CFD, so SPX 500 USD. So when it gets above 58.50, I just want to cross-check it here on SPX CBOE. And 58.50 is just slightly higher. So right now, like I said, I wouldn't be fading this market. I would just manage your longs. And if you are bullish, I'd be watching that upper daily expected move, because from a SPY perspective, looks like there's a target area of 584. Cool? All right, let's go through a couple other names here, and give me 1 second because I just want to just check out my portfolio, because if anything's a little bit frothy, I want to pull a little bit of profit from it. So give me one moment here. No, everything's pretty much well managed in there. I just don't see the need to pull my positions. They're not huge positions, so I can just keep them on. Give me a second here too. I want to check one other portfolio. Yeah, so I'm going to pull a little bit from my Qs on. So I have the main account that I just pulled up there was more of my swing trading, and they're very like well managed positions. The account that I'm pulling up now, I do some more shorter term trades, day trades sometimes, and one of them that was executed into was the Qs, where I bought 200 shares that filled at 496.31. So if I go to Qs, give me a second, sorry. 496.31. It was like right here somewhere. 31. Right here. Okay, execute it right here. Right around here. Intraday. And then I sold a little bit up at 497-ish, right around here. 497.58. Yeah, so right here. So I still have over 100 shares. I'm going to just minimize that position just a little bit, and then keep it on as a runner. So give me a moment. Sorry, I know this is taken away from other time to analyze stocks, but I gotta kind of doing both of these things are kind of annoying, especially if I have to do it from my phone, which I absolutely hate. But I can't log in right now on this computer. Okay. All right, I'm just pulling off slight more to basically say that I took off half of the position intraday. Total. Okay. All right, I'm back. There we go. Executed up here. So the first trade was right here. I removed some up here, and then I just removed a little bit more here. Cool. Qs. Qs. Q. Okay. Let's go back over to the side by side. That was mRNA. Let me pull back up my notes. Pins. And are these reporting earnings? I feel like I got to make sure, like, if they're reporting earnings, people, just be aware of that. Like, a technical analysis, it's pretty much pointless to the point where if we're running into earnings, because then you have to look at the earnings expected move. So if I go to pins, am I going to see earnings right here? Yeah, earnings is right around the corner. Okay, so we need to be aware of this because it brings off an implied move. So go to the trade tab. Make sure that you understand that what the market's pricing in. I don't know if that's actually the right date. When is earnings here? It's going to be this expiration. We're looking at about a $5 expected move for earnings for pins, right? So yeah, this one's choppy. It's all over the place, but we can be up $5 from where we currently are, in the very near future. So if we're looking at these names that have, right around the corner sort of situations, I think it's kind of pointless because I'm not going to initiate personally any new positions so close to earnings. Like this one's a little far out. This is November 20th, so you might have room here. Snow, look at overall larger term trend, it's down, right? 200 days sloping down. The 20 days starting to slope up, 50 days still sloping down. Okay, so yeah, can we see a potential like hold up here? Yeah, absolutely. So I would still look at this at a smaller time frame. So 15-minute time frame, 30-minute time frame. Let's go over here. Snow, boom, 30-minute time frame. We're now getting back above, and we're starting to calculate the 5-day moving average up. So we saw some strength. We've seen some consolidation. Now, if you're entering into a trade when we start seeing strength, you probably would put a stop right there, ideally, right under the daily low and or the day prior. And if you want to get, sneaky, you put a 50% stop here, a 50% stop here, and then you trail it up as soon as you see new, like, so for example, if you entered right here and all of a sudden strength came in, you can move this stop up a little bit and you can move this stop up a little bit too and try to trail a potential change in trend in the short term. But you just want to manage that risk, understanding that the daily time frame, the trends are still, you're fighting a trend, okay? So it's focused in on the shorter term. Let's take a look here really quick on a intraday or an anchor volume weighted average price. Yeah, you definitely want to see it back above that anchor volume weighted average price for the day, 118.60. Okay, and then as far as like maybe a swing low, or yeah, you can just go to this low. Yeah, so see this swing low right here. You can see price action came into it. It found some support. It came into it today, found some support. So the 5-day moving average starts turning up more. This comes in, starts seeing some strength, whatever. This could still be a potentially good setup for a shorter term, like pop or move. Okay, I prefer to watch it digest and see what takes place before going in though. Which means that you can deal with gaps, unfortunately. Okay. Crockies. Crocs earnings today. I let this digest. That's all. Yeah, you can probably see bounces, snapbacks. It's in the midst of volatility. Like I said, I like wait for things to contract and then expand again. So in the midst of volatility, it's 17% down. That's a big move. All right, RSI is kind of burnt to a crisp here. So yeah, can we see a bounce? Yeah, absolutely. But that bounce might just be a consolidation and then a follow back through down. I mean, we saw that happen countless times. Look at Lulu, right? Take a look at Lulu. Right? Earnings, gap, boom, kind of followed through, consolidated, fell. People are like, oh, it's bouncing back. We're good. Boom, right? This is just a pullback in a new downtrend. Pullback in a new downtrend. Now, actually, you start to see here that the shorter term trend, 20 days moving up, 50 days up, but it's fighting the larger term trend. And you saw a move here. So perhaps we set up something like this to eventually kind of trying to retest this 200 day. It's going to be a long time for these kind of names to heal. All right. SCCO. I got to get off here in like a couple minutes. Copper. This is Southern Copper. Obviously, it has a high correlation to copper. I'm bullish copper as long as we can hold and break above this little contraction pattern, right? So yes, on yesterday's brief, we talked about how it can come up to the declining 20-day. I feel like if we broke out of this consolidation, we can hold it, but we got right there rejected back into this small contraction pattern. So for that to work out, I'd want to see a breakout in copper too. But SCCO, I do have a little position in. My stop's down here right now. I was looking at this contraction, potentially a breakout, right? You can look at SCCO, you can look at CPER, right? I'm risking 1 unit to potentially make more. Here's copper getting very tight, or CPER, which is United States Copper Index, another name, right? IRM, I don't know what that is. Iron Mountain. Yeah, I mean, this is incredibly bullish. Earnings is around the corner, though. It feels long in the tooth, so it's not like it felt long in the tooth here, probably here, probably here, probably. Strong stocks typically get stronger. When it gets this disconnected from the 20-day, sometimes even the 50-day, we see pullback. So I'd be looking for basis to get built in something like Iron Mountain. So if you're in it and you're long, you're in a good position. I mean, you have earnings around the corner, so just make sure that if you look at earnings and you say, oh, I don't want to risk, $9 per share or whatever it is, going into earnings. So then you could reduce some of your risk to make up for that, because $9 a share can bring us back down to, 120, which might even just be a pullback to potentially higher highs. We don't know. So you would just want to see that. But even a move down to the 50-day moving average would not be there'd be nothing in the looks of this chart, right? It's just a big, strong move. Now, strong moves can lead to digestion. So I'd be looking for digestions, things like this. Big bases, that build out. But right now, I wouldn't initiate a new position because of earnings, and then 2, it's already long in the tooth as well. So it's kind of one of those holds, and maybe think about managing risk if you're in it, right? That's it. Berkshire. The big Berkshire trade that I liked this year was this one right here. Was over here, right? We talked about this one so many times. We talked about this contraction. It led with MDY, which is more mid-cap stuff, and we saw a massive move. So this is what I talk about when I talk about tight contraction, right? Markets move between expansion and contraction, and the idea here is not to be right or wrong, but if volatility expands, you want to be able on the right side of volatility. So if you're like, I'm going to short right here, and then you held it, you got torn. But if you were wrong and it came down and stopped you out of this tight contraction, you're like, okay, I took a 1-hour loss. I risked 1 unit over here. But this 1 unit turned into 1, 2, 3, 4, maybe if you want more if you held on to it. So right now, on specifically this, I do not like the look of this chart because we're getting below a 20-day moving average currently here. In the 50 days, the longer we trade here around these levels, it's going to average this price data, right, the 50 bars, and if we're trading below it, it's going to start pulling it down and flattening out. So the trend from the medium term and short term chart to change. And I do not like the look of that. So what would I say would be a better look? If we can reclaim these levels and it sets up like something like that. But I would want to see proof of that before just hopping in, because right now we're kind of just channel trading here, and we're getting below some of these key averages, and it looks like it has the potential to break. And I don't want to risk a potential break. I'd prefer to if price broke here, this would be my risk to potentially play it up into here and or more. And if I get stopped out, okay, so what? So that's how I would look at that. Now you might think, okay, well, what if I want to short it? I'm like, okay, just know that you're short. You'd be shorting still technically an inclining 50-day to flat 20-day and then into an inclining 200-day, which you can do and it's fine, but just know that you better make sure that if we start breaking back to the upside, that we don't get squeezed up and you just hold on to a short or average into a loser. There's Berkshire, Adobe. Adobe, right? Bearish earnings move. Let me remove this. Bearish earnings move. We saw bounces, consolidated, right? Follow through, consolidated, follow through. Right now, if I look at this, I bet we have some sort of positive divergence on an RSI, right? Let's just take a look. Let's see here. Yeah, so you have a low, a lower low, you have a low and a higher low in the RSI. So are we nearing a point where we could potentially see a little bit of a pop, but yet it's still in a downtrend? So if that's the case, I'd be like, okay, well, I think that we might have the possibility of a little move in Adobe, right? Breaking out of this tight contraction over here. But let me go to the 15-minute time frame. Oh, okay, this is interesting. Take a look at the 15-minute 5-day moving average. Price action has a low here. And now we're kind of just doodling around this 5-day moving average. So what this means to me is this could be a little flag. It's still down, but if we come and we start breaking out, the 5-day moving average is going to flatten out to turn up. And then we could start to look for levels to potentially play for short-term pops up into and around, other areas of where volume traded. So for example, 496. You don't need the volume shelf profile here. It helps show you that, hey, we're above, the point of control, the POC. Okay. And there's a big air pocket here. So you can maybe fly to 496 because not much volume is there. Okay. But really, if you just look at the chart, you're like, well, where would be the volume, a lot of volume? Well, right here, because there's a lot of candles that traded here, right? And then we kind of sold off. And then we traded more right here. So if you just look at this, oh, volume here, not much here, go figure, what do you know? It's, crazy, right? But yeah, so this could be actually setting up for something here, for a little pop, but just understand that it hasn't proven itself quite yet. But it is setting up that if you're like, hey, I want to do a short term, I think we're going to break up higher. Okay, cool. If you enter in, then make sure you have a stop loss there, or you're being controlled and having it there. Watch Adobe, boom. See how the 30-minute time frame, it's still declining. So you can also do this low, bam, anchor volume weighted average price. Say I'm going long right here because I think that we're going to change. But anything below this, I'm going to get out. And then if it sets back up later, I'll look to re-enter. But the idea of an early entry on Adobe would be because you think that we're going to pop up. But if we don't, manage risk and then understand what that area of risk is to your portfolio. And if that's too small of a stop for you, that is small because you can literally be here tomorrow and you can just gap down to a quick 30-second wick, boom, it rips you out. So, in the midst of volatility in the morning. So you might say, well, I want to control my risk down here. So you would be like, okay, what is that? 485 down to 479. We're just going to round it to $6 per share. So your position size, you're going to back into $6 worth of risk. And your thought here is that you can potentially change a trend here in the early term. And you're going to try to go for a 1R to 1R sort of coin flip or a 2R. But the way you're going to do this is if you get to your 1R risk unit, you might, instead of taking profits, you might move to a break even, or you might take partial profits or half and then leave that same stop and just adjust and manage your risk as you see fit there. All right, y'all, I got to hop off, unfortunately. So it's 10:20. We'll take a quick look at the markets. I'm sorry we didn't get to everything here. My apologies. Markets pressing up a little bit higher, still within the daily expected range. 584 and some change is the upper level there. Market net flow still pointing up here on cumulative net premiums for calls. Puts down, positive, divergence, positive, convergence. We do have a bar here at 584. Don't rule that out. As far as 0-date levels go, let's see if anything changed here and it's gotten a little bit more convincing. Kind of. There's a little bit more action here. Not much. The main area is over here at 558.45, 58.50. So if we go over to the SPX, or we'll pull up on both charts just so you can see the difference. You can see 58.50. Still, we haven't actually tagged on CBOE. So that would be the kind of the level to watch as far as, overhead. And then as far as net gamma go, or the gamma levels on my chart, the O1 chart, we're right there at that 58.50, and 58.45 is right over here. So you came above it and we kind of came back down, right? So if the market is going to really start, breaking from this, I would prefer to see traders to reach out further, right? And then also market net flow to continue to hold. This is not an environment that I would be fading right now. I just wouldn't be doing it. Hope that helps out, everybody. I'll see you on the next episode. Thanks for tuning in, everybody. See you, Moonraker. See you, Stoic. I'll have to adjust you're right, actually, my volume was a little bit lower. My problem, I'm going to have to adjust that on the next stream. See you, Love Set Match. See you, Kyle. See you, Prince. See you, Colby. Art, Biz, Tony, Cigar, Uniworld. See you, Mike. See you.